My background is that I've been in financial services all my working life, and I have specialised in mortgages because I was at one point a mortgage underwriter and a mortgage advisor. I'm actually an IFA, and I have been through the years for about 20 years, and since joining you, my daughter has come to work with me as my administrator, and she's currently doing her mortgage qualifications. So hopefully there will be two of us doing mortgages for Philip James. However, I do all the other financial services. Okay, so each individual case we look at individually, and we will give advice on what the best course of action is. If somebody's coming to the end of a fixed rate with a current lender, we are happy to review that and give them advice as to what the best course of action is. Quite often it might well be that we will have a look at the market as a whole and their circumstances and perhaps recommend a product with their existing provider. Or it may well be that it's advantageous to them to move to a new lender, but it has to be advantageous because we wouldn't want to move people around unnecessarily and incur costs and charges, which is something that we look at very closely when we're looking at people's mortgages to make sure that they're treated fairly and charged accordingly. Not necessarily, because quite often people who fixed 2, 3 or 5 years ago won't have had the advantage of interest rates falling over the sort of 2019-20 coming into 2021. They haven't had that advantage. So quite often I'm finding that we're fixing people's mortgages now and they're actually fixing at slightly lower rates. So it's definitely worth reviewing the mortgage, and it's definitely worth reviewing it with us given our experience and expertise in the field. I cherish first-time buyers. I really do. I love helping them, and it's very, very rewarding to help them to get to where they need to be, with or without parental help, which is happening a lot. And there are lots of new innovations coming forward through the mortgage world, if you like, whereby parents can have a helping hand towards their children's mortgages, whether it be in terms of if they haven't perhaps got the capital to help their children with a deposit. It may well be that they have assets of their own that can be utilised, or it may well be that they can even go on to a child's mortgage with them as a person that is supporting the extra income needed to give a first-time buyer what they need to get the home that they want. The rule of thumb, it's a roundabout for a first-time buyer 4.5 times income, but that's very general. That's not scientific enough for anybody to just go and select a mortgage off the shelf, because there are so many other factors to bring to bear. 5% would be a minimum. 5% would be a minimum, really. The bigger the deposit, the better the rate. The more somebody can put down, the better the rate they will get, because it's all based on risk, and lenders have factored risk into what they will lend, and that comes down to the value of the property and how much the person wants to borrow based on that risk.